The market is an unforgiving battlefield, a vast arena where men and women test not only their ideas but their very character. Every morning it opens its gates to dreamers, gamblers, and would-be conquerors. Most enter with the same intoxicating thought burning in their minds. How much money can I make? They see the flashing tape, the endless tick of prices, and imagine fortune as a prize waiting to be seized. These hopeful adventurers are united by one fatal trait. They think first of reward and last of risk. They march onto the field like soldiers who have forgotten that the enemy is armed. I know these people well because I once walked among them. Early in my career, I was that reckless adventurer, intoxicated by the promise of quick riches. I learned, at a cost far greater than tuition at any university, that this is the surest path to ruin. The market is not a friendly game. It is a machine designed to exploit the weak, the careless, and the undisciplined. The amateur dreams of profits. The professional thinks first, last, and always of survival. This is the first great dividing line in speculation. The man who endures asks a different question than the man who perishes. The novice asks, "How much can I make?" The seasoned operator asks, "How much can I afford to lose?" This single change of focus from reward to risk marks the birth of a professional. Understand this. Capital is everything. A speculator without capital is like a general without an army or a merchant with empty shelves. He may possess brilliance, courage, even flawless judgment, but without the ammunition of cash, he is no longer in the game. His opinions, no matter how clever, are worthless. His past victories are nothing more than stories told over a bar-room counter. The market listens only to those who still have money to speak with. Therefore, the first law of speculation is simple and absolute. Preserve capital above all else. All other rules, cutting losses, sizing positions, letting profits run, are but children of this single parent. Your primary goal is not to grow rich tomorrow. It is to remain solvent tomorrow, and the day after that, and the day after that. Riches may follow, but only if you survive long enough to let probability work in your favor. How does one preserve capital in a world that seems built to destroy it? Not with hope, not with bravado. Preservation is achieved through a system of definite, logical, and inviolable laws. A defensive fortress built stone by stone. Every brick in that fortress is laid with one question in mind. Does this action increase or decrease the risk to my main capital base? Consider first the matter of position sizing, for here most fortunes are lost before the trade is even placed. The amateur, swollen with conviction, will risk a reckless portion of his account on a single idea, 10, 20, even 50% of his total stake. He believes the strength of his opinion grants him immunity from the laws of probability. It does not. Even if he is correct 9 times in 10, the one time he is wrong will be enough to wipe him out completely. The professional does the opposite. No matter how strong his belief in a trade, he limits the loss from that single venture to a fraction so small that a series of defeats cannot drive him from the field. In my own practice, I have found that risking no more than 1 or 2% of total capital on any single operation provides a mathematical guarantee of survival. At 1%, a trader could suffer 20 consecutive stop-outs and still retain 4/5 of his stake. At 2%, 10 consecutive defeats would still leave him with nearly 80% of his resources intact. This arithmetic is not exciting, but it is the arithmetic of endurance. Think of your trading capital as the inventory of a great store. Would a shopkeeper allow a thief to walk in and carry off his goods because he felt sure the thief would return them? Would he risk half his stock on a single customer in the hope of a spectacular profit? Of course not. Yet speculators do this every day, handing over their lifeblood to the market with the casualness of a man tipping a waiter. To protect this capital, every trade must be entered with a predetermined exit, a stop-loss that defines the exact amount you are willing to sacrifice if the market proves you wrong. A stop is not an admission of weakness, it is a badge of professionalism. It is a simple business expense like the insurance a merchant pays to protect his warehouse. A small loss taken quickly is a scratch that heals overnight. A loss ignored out of hope or pride becomes a gangrene that spreads until the account is amputated entirely. This defensive mindset is not timid. On the contrary, it is the highest form of courage. It takes courage to risk a small amount when the crowd is throwing their fortunes at a single bet. It takes courage to admit error quickly and move to the sidelines while others cling to their fading hopes. It takes courage to do nothing, sometimes for days or weeks, until the market itself offers a clear invitation. Understand this well. The market rewards patience and punishes compulsion. There is no prize for constant action, no bonus for the number of trades you place. The professional spends most of his time waiting, conserving both his financial capital and his mental capital, so that when the rare high-probability opportunity arrives, he can strike with overwhelming force, yet always within the boundaries of his risk plan. This is the prime directive. Preserve your capital as a soldier guards his ammunition, as a mother guards her child. Every other law of speculation flows from this single fountainhead. If you forget every other lesson but remember this one, you will already be far ahead of the great majority who enter this arena. Survive first. The profits will take care of themselves. Cut losses quickly. This is the first practical command that flows from the prime directive of preserving capital. If the first rule is to survive, then the first action must be the swift and merciless cutting of a loss. A loss is not an opinion. It is a fact. It is the market's own cold and impersonal verdict that your judgment was wrong. To delay accepting that verdict is to invite disaster. The amateur treats a loss as a personal insult. When the market moves against him, he argues with the tape. He tells himself it is only a temporary reaction, a shakeout of weak hands. He whispers comforting lies while the price continues its relentless drift in the wrong direction. He clings to hope as his house burns down around him. A small loss, when taken quickly, is a minor expense, a routine cost of doing business. Left unattended, it grows into a crippling wound. The professional speculator acts without hesitation. The instant his predetermined stop is reached, he sells. No debate, no delay, no prayer for a miracle. He knows that a small loss taken at once is a cheap lesson and a cheap insurance premium. He treats it as a scratch that heals overnight. A large loss, by contrast, is a chain around the ankle that drags down every future decision. It clouds the mind and poisons judgment. It turns a clear thinker into a desperate gambler. The mathematics of cutting losses are simple but unforgiving. Suppose you lose 10% of your account. You must gain more than 11% to return to even. Lose 50%, and you need a 100% gain just to break even. Each additional loss demands an ever larger and more improbable recovery. The surest way to avoid the impossible task of clawing back from ruin is to never allow a single loss to grow large in the first place. This discipline is not easy. It requires the strength to accept error publicly and immediately. The human ego resists. It hates to be wrong. It whispers that patience will reward you, that the market will turn in your favor if only you hold on a little longer. But the market does not care about your pride. It rewards only those who obey its verdicts. The stop-loss is a weapon against ego. It is a contract you make with yourself in the calm of preparation, so that when the storm arrives, you act automatically. A trader who risks no more than 1 or 2% of total capital on any single trade, and who cuts a loss the instant it reaches that limit, possesses a mathematical edge that cannot be taken away. He can suffer a string of 10, 15, even 20 consecutive defeats and still retain the majority of his stake. He remains alive, ready to fight another day, while the amateur is carried out on a stretcher. To cut losses quickly is not to admit weakness. It is to demonstrate the highest form of strength, the strength to protect your future opportunities at the cost of a small present pain. It is the habit that separates the operator who endures from the gambler who vanishes. Take the small loss. Take it immediately. Take it every time your stop is hit. This is not cowardice. It is professionalism. Never average down a losing position. Of all the errors that drain a trader's account, this is the most seductive and the most destructive. It is the act of not only failing to cut a loss, but of deliberately adding to it. The market has already spoken, the price has moved against you, and yet the undisciplined speculator answers by buying more. He tells himself that a stock he liked at 50 must be an even greater bargain at 40. In reality, he is throwing good money after bad, doubling his exposure to a proven mistake. The amateur believes he is being clever. He imagines that by lowering his average cost, he is making it easier to break even. He does not see that the lower price is not a gift but a warning. A stock that falls from 50 to 40 is not cheaper, it is weaker. Its own action has proven that the line of least resistance is downward. To buy more is to argue with the market's verdict, and the market always wins that argument. The professional speculator follows the opposite principle. He never reinforces failure. He reinforces success. He adds to a position only when it is proving him right, never when it is proving him wrong. He pyramids profits, not losses. To average down is to defy the very logic of survival. It is to send fresh troops into a battle that is already being lost. Consider the arithmetic. Suppose you buy a stock at 50 and it drops to 40. You buy more, lowering your average to 45. If the decline continues to 30, your combined position now suffers a loss far greater than if you had simply accepted the original small defeat. The larger stake magnifies the pain and accelerates the destruction of capital. The very act meant to make recovery easier has instead made ruin more certain. This mistake is born not of strategy but of emotion, hope, pride, and the desperate desire to escape a loss without admitting error. The trader clings to the fantasy of a quick rebound that will restore his dignity. He forgets that the market does not care about his dignity. It rewards only those who act on evidence, not on hope. The iron rule is clear. Never, under any circumstances, add to a losing position. A trade that is showing a loss should be closed, not enlarged. To violate this rule is to betray the first duty of speculation, which is the preservation of capital. When you find yourself in a hole, stop digging. Cut the loss, accept the lesson, and move on with your resources and your judgment intact. Let profits run. This is the positive twin of cutting losses. The speculator who masters the art of taking small losses has solved the problem of survival. But to move from mere survival to true wealth, he must master the harder art of holding a winner. The same fear that tempts the amateur to cling to a loser also tempts him to sell a winner too soon. A trade moves quickly in his favor, and he feels a nervous urge to grab the gain before it slips away. He whispers the most dangerous of market platitudes. You can't go broke taking a profit. And so he sells, snatching a small gain that will never offset the one large loss he refused to cut. While it is true that a man cannot go broke by taking a single profit, a career built on small, timid wins is doomed to mediocrity. A handful of quick gains cannot outweigh the mathematics of an occasional large loss. The professional knows that the big money is never made in the first burst of a move, but in the long, quiet middle of a great trend. Jesse Livermore said it was never his thinking that made the large profits, it was his sitting. The courage to hold, to endure the normal pullbacks and the daily noise is what transforms a 10-point gain into a 100-point campaign. To let profits run does not mean blind hope. It means holding a position as long as the market itself continues to confirm your premise. As long as the price action and the volume show strength, as long as the trend remains intact, the professional resists the urge to cash in. He moves his stop to protect a portion of the gain, but he does not rush to take the first small harvest. He waits for the full maturity of the move. This patience is a test of character. It demands the strength to ignore the chatter of friends, the noise of news, and the tremors of minor corrections. It demands faith not in hope, but in the evidence of the tape. It demands the humility to let the market, not the trader's nerves, determine the exit. The operator who learns to cut losses quickly and to let profits run has solved the two great equations of speculation. Small losses keep him alive. Large winners give him wealth. Every other rule of trading is a refinement of these two simple but difficult disciplines. Accept small defeats without delay. Allow true victories to reach their natural and sometimes magnificent conclusion. Never overtrade. The market does not pay for activity. It pays for accuracy. Yet the novice feels an almost physical need to always have a position. To him, being in cash feels like failure, like standing idle while opportunity passes by. He confuses action with progress and mistakes movement for mastery. Driven by impatience, he buys and sells on every small fluctuation, chasing minor wiggles in price as if they held the promise of fortune. This habit is fatal. Frequent trades mean frequent commissions and slippage, each a small leak in the trader's ship. More dangerous still, constant trading erodes mental capital. The operator who is always in the market is always entangled, his judgment clouded by the fear or excitement of his last trade. He loses perspective. He cannot see the larger currents because his attention is consumed by the ripples. The professional speculator understands that most of the time the market offers nothing worth risking capital on. He conserves both his money and his mind. He waits patiently for the rare conditions that align in his favor. When those moments arrive, he acts decisively. When they are absent, he does nothing at all. He knows that cash is a position, a strategic reserve, and often the most profitable one. To be flat is not to be defeated. It is to stand ready. Overtrading is a symptom of deeper weakness, the craving for excitement, the need to feel busy, the fear of missing out. The cure is discipline. Define your setups in advance. Enter only when the market meets those conditions. Refuse every other invitation, no matter how tempting. Your edge lies not in how many trades you take, but in how well you select them. Speculation is not a game of constant motion. It is a game of waiting for the one high-probability moment and then striking with calculated force. The fewer trades you take, provided they are the right ones, the greater your chance of lasting success. Trade less, think more, and let the market's rare opportunities, not your restless impulses, dictate when you act. Risk only a small fraction of capital on each trade. This is the mathematical backbone of every other rule. Position sizing is not a detail to be decided on impulse. It is the foundation of survival. The amateur, convinced of a brilliant idea, will sometimes risk 10, 20, even 50% of his entire stake on a single venture. He treats the market like a roulette wheel, believing that conviction can bend probability to his will. It cannot. Even the best judgment is wrong often enough to destroy a man who bets too heavily. The professional speculator approaches every trade with cold arithmetic. No matter how confident he feels, he limits the possible loss to an amount so small that a string of defeats cannot force him from the game. In my own practice, I have found that risking no more than 1 or 2% of total capital on any single operation provides a margin of safety that no market storm can erase. At 1%, a trader could suffer 20 consecutive losses and still retain 4/5 of his stake. At 2%, 10 consecutive defeats would still leave him with nearly 80% of his resources intact. This is not timid mathematics. It is the mathematics of endurance. The great advantage of small risk is psychological as well as financial. A man who knows that the worst possible outcome of any trade is a modest, predetermined loss can operate without fear. His mind is free to follow the evidence of the tape instead of the tremors of anxiety. He does not tighten stops out of panic or widen them out of desperation. He acts with clarity because he knows that no single trade can deliver a fatal blow. This discipline is the hidden source of speculative courage. The amateur believes courage means betting big. In truth, courage means building a plan so sound that you can trade boldly without risking ruin. By risking only a small fraction of your capital on each position, you make it mathematically impossible for the market to put you out of business. And once survival is guaranteed, profits become a question of skill and patience, not luck. The market will always tempt you to increase your stake when confidence is high. Resist it. Keep your risk per trade small, consistent, and pre-planned. Let the compounding of many small, controlled victories build your fortune, rather than gambling everything on a single grand opinion. Survival is the first victory. Small risk is the surest path to survival. Wait for clear market signals. The great game of speculation is not a game of prediction. It is a game of reaction. The amateur is always trying to make something happen. He guesses, he hopes, he forces trades because he cannot stand the stillness of waiting. He treats the market like a puzzle to be solved in advance, believing that cleverness will reveal tomorrow's prices today. This is folly. The market does not reward the man who anticipates. It rewards the man who responds. The professional speculator waits with calm vigilance for the market itself to speak. He does not act on rumor, opinion, or wishful thinking. He acts only when price action delivers a clear and unmistakable signal. That signal is the breakout from a pivotal point. The moment when a stock or a market moves with sudden force and volume to announce a new trend. Such a move is not subtle. It is definite. It is a declaration of intent. To buy before this confirmation is to gamble. To buy after it is to act on evidence. The professional knows the difference. He may watch a stock for weeks, even months, studying its behavior, noting the levels where smart money quietly accumulates. He waits for the surge in price and the expansion in volume that reveal the presence of powerful sponsorship. Only then does he commit his capital, and even then he commits only a carefully calculated fraction of it. This discipline demands patience, and patience demands strength. While others chase small swings and noisy rumors, the professional sits in cash, conserving both money and mental energy. He knows that true opportunities are rare and that missing a mediocre trade is far less costly than forcing a bad one. When the genuine signal arrives, he recognizes it instantly because he has been waiting for nothing else. The market is not a continuous performance. It is a series of rare and valuable opportunities separated by long periods of confusion. Your task is not to fill the time with activity. Your task is to remain alert and ready so that when the market finally reveals its hand, you can strike without hesitation. Wait for the signal, react with precision, and remember that patience is itself a position, one of the most profitable you will ever take. Cash is a position. The inexperienced trader believes that to be in the market is to be a speculator, and to be out of the market is to be nothing. He feels restless when he is flat. He fears that every idle day is a missed opportunity. This is a costly illusion. Cash is not inactivity. Cash is power. To hold cash is to hold freedom. It is the freedom to wait for the right conditions without the drag of losing trades or the noise of constant price fluctuations. It is the freedom to observe the market with a clear and detached mind, unclouded by the hope or fear that comes from having money at risk. Cash allows the trader to stand aside during periods of confusion to avoid the 1,000 small cuts that bleed impatient players who insist on always being involved. The professional treats cash as an active strategy. He knows there are long stretches when the market offers nothing but traps and noise. During these times, he sells his positions, banks his profits, and waits. He understands that every dollar preserved is a bullet saved for the next true opportunity. While others are whipsawed by meaningless fluctuations, he studies the tape from a position of safety, conserving not only his financial capital but also his mental and emotional capital. Being in cash is not weakness. It is the highest form of discipline. It signals that you are guided by the market and not by the restless need to act. The amateur trades because he feels he must. The professional trades only when he should. He knows that the rare moments of clear advantage repay the long periods of patient observation many times over. Remember this whenever the market tempts you with boredom or fear of missing out. To be in cash is to be ready. It is to stand like a general with an untouched reserve, waiting for the signal to strike. Cash is not a retreat. It is a strategic position, often the strongest position of all. Never trust tips or other people's opinions. The successful speculator must learn to think and act for himself. The moment you allow another person's conviction to guide your trades, you have surrendered not only your capital, but your judgment. Wall Street is a great echo chamber of rumors, tips, and so-called inside information. Most of it is nothing more than noise, guesses, hopes, and deliberate manipulation dressed up as certainty. The amateur hungers for shortcuts. He believes that somewhere, someone possesses a secret that will spare him the hard work of study and discipline. So he listens to the confident voice of a friend, a broker, a news commentator, or an internet forum. He forgets to ask the simplest question of all. If this information is truly valuable, why is it being given away? In most cases, a tip is either worthless or dangerous. If it were truly profitable, it would not be shared. Acting on a tip is worse than gambling. When you trade on another person's opinion, you do not know the real reason for buying, and therefore you will never know the right reason for selling. You become a follower, dependent on guidance you cannot control. Your timing will always be late, your exits uncertain, and your confidence fragile. You are like a blind man led by another blind man, and both will end in the ditch. The professional does his own work. He studies the tape, the price action, the volume. He forms his own conclusions and accepts full responsibility for both profits and losses. He may listen politely to others, but his decisions are his own. He understands that even the most respected expert cannot guarantee a single trade. The market is the only authority, and its verdict is final. Learn this lesson early. No man can give you sustained profits. Only your own disciplined observation and your own tested method can protect your capital. Lock the door of your mind against the opinions of others. Think for yourself, act for yourself, and let the market, not a whisper or a rumor, be your guide. Patience is protection. To the restless trader, patience looks like inactivity. To the seasoned operator, it is an active and powerful defense. Most losses in speculation are not caused by faulty analysis, but by the inability to wait. The amateur cannot endure the silence between true opportunities. He forces trades to satisfy his need for action, and in doing so invites the market to punish him. Patience shields you from two great dangers: emotional impulse and market deception. Sideways markets and choppy ranges are designed to exhaust the impatient. Prices swing back and forth, luring the trader into one false move after another until his capital is drained by 1,000 small cuts. The patient trader stands aside, content to let the noise pass. He knows that a clear trend will eventually emerge, and he saves both money and mental energy for that decisive moment. Patience also guards against chasing strength after it has already spent itself. A stock that has made a long and powerful advance will tempt the fearful trader to buy at the top, desperate not to miss the move. The professional lets it go. He understands that to buy late is to buy wrong. He knows the market will parade an endless series of opportunities, and that missing one is of no consequence if you are ready for the next. Patience is equally vital when sitting with a winning position. A true trend unfolds over time, and every great move contains normal reactions and pullbacks. The impatient trader sells at the first sign of weakness, turning a potential 100-point campaign into a 10-point scratch. The professional waits, holding as long as the market continues to confirm his premise. He accepts the daily fluctuations as the cost of capturing the larger swing. The market pays those who wait. It pays for waiting before entry, and it pays for waiting during a profitable campaign. Every other moment, every forced trade, every hasty exit is a potential source of loss. Cultivate the discipline to do nothing until the market itself commands action. In speculation, patience is not passive. It is the strongest armor you can wear. The market is always right. A speculator deals in opinions, but the market deals in facts. Your analysis may be brilliant, your reasoning flawless, your conviction unshakable, yet if the price moves against you, the market has rendered its verdict. To insist that the market is wrong is to invite ruin. The tape is the supreme court of speculation, and its judgment is final. The amateur cannot accept this. When a trade turns against him, he says, "The market is wrong. This stock should be going up." He clings to his belief as the price sinks lower, confusing stubbornness with strength. But the market is never wrong. It simply is. It reflects the sum of all knowledge, all opinions, and all forces acting in the present moment. Your opinion, no matter how carefully formed, can be wrong, and often is. The professional accepts this truth without argument. He enters every trade with a predetermined stop-loss and obeys it without hesitation. When the stop is hit, he does not debate or delay. He acknowledges that the market has invalidated his idea and closes the position. This is not weakness. It is discipline. It is the recognition that capital preservation matters more than pride. Consider the mathematics once more. A small loss taken at your stop is a manageable business expense. A loss that grows because you insisted on being right can wipe out weeks or months of careful work. The market will continue to trade tomorrow, next week, and next year. Your first duty is to remain solvent long enough to see those tomorrows. Admitting that the market is always right is the surest way to stay alive. The stop loss is the practical expression of this principle. It enforces humility. It turns the abstract acknowledgement of fallibility into concrete action. Each time you honor your stop, you affirm a simple truth. The market decides, not you. And in that surrender lies survival. To argue with the market is to argue with reality itself, and reality always wins. Control emotions. This is the master rule, the one that makes all the others possible. The market is a machine designed to exploit human weakness. It tempts with greed. It frightens with sudden drops. It flatters with small wins. And it humiliates with unexpected reversals. If you cannot master yourself, no set of rules will protect your capital for long. Every other principle is a defense against a particular emotion. The stop loss is a shield against hope. The rule of small risk is a shield against reckless confidence. The practice of patience is a shield against fear of missing out. Each law exists to keep the trader's rational mind in control while the primitive instincts of fear and greed roar for attention. The amateur allows these instincts to dictate his decisions. He buys because he feels excited. He holds because he hopes. He sells because he is afraid. The professional acts from calculation, not feeling. He enters only when the market provides a clear signal. He exits when the signal is broken. He risks only a small percentage of capital so that no single outcome can unbalance his mind. This emotional discipline is not coldness for its own sake. It is the condition for clear thinking. A trader who knows that his maximum loss on any trade is 1 or 2% of capital can accept defeat without panic. A trader who cuts a loss quickly does not carry the weight of yesterday's mistake into today's decision. A trader who waits for clear signals is free from the anxiety of constant action. Control of emotions does not mean the absence of feeling. It means the refusal to let feeling issue the orders. The professional may feel excitement, fear, or disappointment, but he does not trade on them. He trades on evidence, on mathematics, and on the unchanging principle of capital preservation. The greatest battle in speculation is not fought on the floor of an exchange or on a trading screen. It is fought within the trader himself. Master your own mind, and the market cannot master you. Lose that inner battle, and no method, no tip, no system will save you. Discipline of thought is the final edge. With it, you are invincible. Without it, you are prey.